do this last class, and I realized that this is really a software class. This is not so much, I'm not going to go into the depths of bookkeeping and accounting. You could go to college and learn that if that's what you want, but you don't need to know like everything about accounting to be able to work in QuickBooks, okay? But I do feel like I want you guys to at least understand the basics of accounting so that you can understand what the software is doing. Because the software is doing all the accounting. You need to learn how to use the software so that you can be the liaison between your client. But there'll be times where you're like, wait a second, the software did something. And if you have a basic understanding of accounting, then you can understand what that something is. This stuff used to make me cry in college. I don't know why my brain just never, it took so long for this stuff to click. So if you're feeling a little like, wait a second, this is confusing, that's okay, because again, it took me forever to do it. I'm kind of like dyslexic as well, so like even left and right would sometimes get me. So when it's binary, it's like this or that, sometimes it can make my brain like struggle to understand it. So I just want you guys to take notes. Don't feel like you have to understand it. The test is open note. Anytime that you're working, you can always go back to your notes, and you don't have to have this stuff stored in memory ready to fire off. The more that you practice it, the better you'll get at it, okay? So first things first, I always want to go back to the accounting equation. And we talked about this last week, right? This is really the basis of everything. It is the principle that assets are equal to the sum of liabilities and equity, okay? So in accounting, you're going to find balance is like the main topic. Everything has to balance. If it doesn't balance, you know, 1 plus 1 is never going to equal 3, right? And when we're talking about money, it's the same thing, right? If I gave you $20, you're not going to give me back $10 in change if the product was $20, right? You're going to make sure you give me the right change back. And so this is really the basis of how the system is rolling, but there's other important pieces which we touched on last week, which were the 5 account types, okay? So I want you guys to take a moment and write this down, because it's really important that these 5 account types translate to you in your mind of different types of accounts that can be in our system, okay? And so just take a moment, write this down. You can make a table if you want. I should have shared this. I'll put this slide deck into the important links as well, just so that you guys can take notes on it. But again, for Jeopardy, you might want this part. Okay.
He's excited to see me.
So remember, we talked about, let's just go through a couple of asset accounts, right? Our most liquid asset is cash. And that could be cash that's in our pocket, in our wallet. That could be cash that's in our bank account. That could be cash that's in a money market account. That could be cash that's in a savings account. It doesn't matter where it's at. It's the most liquid when it's in that form, okay? The next most liquid form of an asset, we call them current assets. And you'll hear that term. It represents assets that can be converted into cash in less than a year, okay? And so typically those are going to be accounts receivables. Fixed assets are typically assets that it would take a little bit longer than a year to convert them into cash. Not always, right? Because this can be our computer. If I put my computer on Facebook Marketplace, I would probably sell tomorrow. Maybe, maybe not. I might be overestimating the value of my computer. But typically we say fixed assets will take longer than a year to sell, okay? Also, the thing about fixed assets is that we're usually going to depreciate them as well, because they diminish in value. The only fixed asset that doesn't diminish in value is land, right? When you own land, it's not going to get less valuable over time. It's probably going to appreciate over time, okay? And then the next asset that is, again, kind of, it's definitely another form of fixed assets, but you'll typically hear people refer to it as PPE. It stands for plants, property, and equipment. So plants can just be the building as well. Property, again, is kind of those fixed assets. Equipment can be, you know, if you are in a landscaping business, you might need a special lawnmower to do that work. If you're in the t-shirt press business, you might have a whole little printer press, all of that stuff, equipment that you actually own, okay? Because sometimes our clients will rent equipment, but in most cases, they own their equipment, okay? And then inventory is another asset, okay? So a lot of the times people are like, wait, isn't inventory an expense? No, inventory is an asset because, again, we're going to take that inventory and turn it into money, right? We're going to sell it and we're going to turn it into money. The last asset that I want you guys to be familiar with, and this is not an exhaustive list. I tried to list as many examples as possible, but it can get more than this, right? And depending on the business type, the assets can be more detailed, okay? Accumulated depreciation is what we call a contra asset. So it actually decreases the value of the assets, but it's still going to be captured on the balance sheet in the asset section, okay? The next account type is liabilities. We talked a little bit about that. Typically, you're going to see credit cards at the top. Those are usually for small business owners the easiest ways for them to get debt. Okay, most of them haven't built up their business EIN score so that they can go out into the bank and say, give me a $50,000 loan. And so what they'll do is they'll take their own personal credit cards and use them only for business. Okay, so that's the most common liability that you're going to see in QuickBooks Online as a business owner just using their personal credit, or maybe they have a business credit card. Okay, accounts payable, again, that's a liability that represents money that I owe to other people. Okay, so in the homework tonight and the expense and vendor section, you guys are going to get really familiar with that part. Notes payable, I put note payable, but notes payable is typically what we hear. And that's going to be long-term loans. This is usually going to be money that we owe someone that we're going to pay for over a year, okay? We've got mortgage payable. Sometimes our business owners will own the building that they operate in, and they have a mortgage on that building. And so that loan is what is the actual liability. Every time that they pay down the loan, they're getting closer and closer to that building becoming an asset. But as long as it's got that liability on it, it's not their building. It belongs to someone else. Just like if you go to the car dealership, you can be driving around that BMW, but if it's got a car note on it, it's not your car until you finish paying it and you get that title in your hand. Okay? Payroll liabilities, we talked a little bit about this. We're going to dig really deep into it. I just wanted to list that in the list. Okay? Owner's equity, talked about that as well. So remember that these three accounts are really going to be our assets, liabilities, and owner's equity. That's our accounting equation. That is our balance sheet, okay? So owner's equity is really simple. That's just the capital. And when I talk about capital, I'm talking about the money that the business owners have put into the business, okay? And that can look like two different, well, really the business owners can put money in and they can take money out of the business, okay? If they take money out, it's called a draw. If they put money in, it's called a contribution, okay? And sometimes those contributions don't always look like them putting their money in. Sometimes business owners will value their time as an equity contribution, right? Because if they were to work anywhere else, they would get money for their time. So sometimes they'll value their time and put that into their balance sheet as their equity. Okay? They may even put in their own assets, and they will recognize that as their equity contribution. Okay? The last two accounts are really simple. We talked about these, revenue and expenses. Revenue can look like selling a product. It can look like selling a service. And then the most uncommon one, or I won't say uncommon, but it's usually not a lot of money, is interest income. So sometimes our business owners will have their money in interest-bearing checking accounts. And so every month they're earning interest. Well, they
savings accounts too, right?
Yep, savings accounts as well can be interest-bearing as well. And so that's not from their primary business activity, but it's still 8 cents that they earn every year. It's very little money, but we still account for it because we account for every penny. And then we have expenses, which I didn't give an exhaustive list. I just kind of named a few: salaries and wages, utilities, office supply, rent, advertising, and cost of goods sold. Okay? Hello.
Oh, so is this the DYP?
No, this is bookkeeping.
Okay.
Okay, no. All right, so with those 5 account types in mind, I wanted to show you guys kind of the impact of the debits and the credits, okay? So typically, before I became an accountant, before I went to school, the only time I had heard debits and credits was like my debit card or my credit card, and I was really thinking like, oh, okay, this is like my debit and my credit card. This is completely unrelated, okay? This is about balancing again, okay? And so debits have an impact on certain accounts, and credits also do. So we have our 5 accounts here. Actually, yeah. We've got the 5 different account types here: assets, expenses, liabilities, equity, and revenue. And then we have the impact of what a debit does to them and what a credit does to them. So I want you guys to take notes on this table, and then we're going to jump into an example, and it'll make sense. So debits and credits are really just how the actual transactions impact our accounting system, right? Because they're either going to increase the account or they're going to decrease the account. And whether they increase or decrease depends on the account type. So assets, if you debit them, they're going to increase. If you credit them, they're going to decrease. So let's give an example, really basic. The bank account, right? If I debit my bank account, I'm increasing it. If I credit my bank account, I'm decreasing it. So an example, Jake gives me $20. I'm going to debit my bank account, increase it, okay? And Jade is going to credit her bank account, decrease it, because she lost $20. So again, it always has to be balanced. If I got $20, she lost $20, okay? Expenses. Similar to assets, whenever we debit them, they're going to increase. Whenever we credit them, they're going to decrease, okay? So, again, another great example of that would be rent. When I pay my rent at my office, I'm going to be increasing my expense account, okay? I'm also going to be decreasing my asset account. So when I did pay the expense account went up, the bank account went down, okay? Yeah, I know.
He is so excited to see you.
He is going. This guy right here is the future of accounting.
Hi.
He's been literally learning accounting since he was in the womb.
Cute.
She's just getting so excited. Okay, so the last 3 accounts are increased by credits. So a liability account, right? Anytime that I take a loan, I'm increasing my liabilities, so I need to credit that loan account, okay? Anytime that I pay that loan, I'm decreasing the liability because I'm paying it. I'm also decreasing my bank account because the asset has to. The bank account is an asset and has to pay that loan, okay? So again, this used to confuse me. If it's not sinking in, it's okay. Just write the table down, because even if you can refer to the table, you'll be fine. Okay. The biggest thing is translating it. Am I working with an asset account? Okay, cool. I'm increasing it. It's a debit. Am I working with the liability account? Okay, cool. Am I decreasing it? I need to credit it or debit it. Sorry. Okay. So equity works the same way. Revenue works the same way. Let's jump into some examples, and it'll make more sense. So I just kind of went over that. That's what this table captures. When I was in college, there was an acronym. It was remember this or you're dead. And so DEAD stands for debits, increase expenses, assets, and dividends. Okay. I didn't like that one too much. There's another one that's I included in the let me just go to it. Important link spreadsheet, and it says it gives an acronym called dealer, which I actually liked that acronym. So here in this folder called Chart of Accounts Resources, there is a PDF called dealer.pdf, and it gives you a really beautiful acronym: dividends, expenses, assets, liabilities, equity, and revenue. The first 3 accounts, dividends, expenses, and assets, are increased by a debit. The last 3 accounts, liabilities, equity, and revenue, are increased by a credit. So if you like acronyms and that helps you remember, dealer is a good one. Remember this or you're dead is another one. Okay. Do you need me to go down?
No, it was actually. Yeah, you know. I was trying to look at the other one.
No, take a second, write that down. And again, these resources are in that important links. that important spreadsheet. I'm trying to give you guys as much as you can without overwhelming you and also helping you navigate it, okay? So I want to jump into a couple of examples so you guys can see this in real time, because sometimes when you actually are thinking about the way money flows, it makes more sense. So this is another slide to just represent the credit account.
Wait, can we go back?
Yeah.
There you go.
Okay. So credits increase liabilities, equity, and revenue.
I was on the other one still.
Okay, let's go back to the debit one. Debits increase expenses, assets, and dividends. Let me know when you guys are ready. Okay. Credits increase liabilities, equity, and revenue. Okay. So if you've ever taken an accounting class before, I'm sure you're familiar with this. Again, this is the easy part, just kind of understanding. The hard part is understanding when the money is moving, how these accounts are going to be impacted. So just a reminder, this is more of a software class, so you don't have to put this into mind, right? Because the software does it, but it's always good to be able to understand what the software is doing, okay? So in this example, we've got Judy's apple stand, and she's preparing for a big day at the farmer's market. She buys 100 apples to sell from her vendor for 10 cents per apple. How does Judy record this in her bookkeeping system? Okay, so what we're dealing with in this transaction is something really simple, right? She's going to her vendor and she's buying some apples. The price per apple is 10 cents. She's buying 100 apples. So she's only spending $10. And what happens is she's increasing her inventory. So that's her asset account. So we need to debit the inventory. And then she's going to decrease her bank account or her cash to buy those apples, okay? And so we really had two accounts being impacted. An asset account, which we're debiting to increase, and then we also have another asset account, which we're crediting to decrease. So if one asset goes up, the other one needs to go down, okay? That's just the balance. That's how we gotta make it balance. Does that make sense? Does anybody have questions on that one? It's a really basic example, okay? So now she goes to the apples, to the farmer's market. It's the big day, and her first customer, Amy, buys 30 apples for her. She's selling those same apples that she bought for 10 cents for $1, so she's getting a good markup, okay? How does she record the sale of the apples? So the first thing that she gets is cash. Amy's giving her $30, okay? And her income is going to increase because of that. So cash is a asset account. Income is a revenue account. So we're going to increase the cash, and we're also going to increase the revenue.
Trust me.
So that's really what's happening here.
Come knock on the door.
Okay, so let's do our third example now. Same situation. So she's actually now sold the apples to her, but now she has 30 less apples. And that's going to be important for her to recognize, because she can't sell, she only bought 100 apples, she can't sell 200. So she needs to be keeping track of her inventory as well. So for those 30 apples, she actually paid 10 cents for them. Not only do we need to record the inventory, but we also need to now recognize that cost that per each sale, okay? So what we're going to do, the cost of goods sold is an expense account. Anytime we want to increase an expense account, what do we need to do to it? Debit, yeah. So we're going to debit that expense account $3 to recognize that those 30 apples that she sold only cost her $3. And now we need to decrease the inventory account, which is an asset, to show that there's 30 less apples in the bunch. And so it's interesting because we see $3 here, but we know that it's representative of 30 apples. Okay, she may have a whole nother system that she uses to keep track of that 70 apples that are less, but we're more concerned with the actual cost, because we know that we paid $10, right? And now 10 of those dollars, we can actually like recognize that expense, saying, okay, we sold 30 apples, those apples cost us $3. Okay, so basic, but it's also kind of complicated because that one sale really had 3 transactions in it, because before she could even ever sell the 30 apples, she had to buy them, Then she had to sell them, and then she had to recognize, hey, I no longer have those apples for sale. Okay? So, basic example, we're gonna practice a lot more of this today. I wanna have some fun with you guys today, because I know that some of these topics can start to feel like, ugh. So we're gonna play Jeopardy. And I'm gonna stop recording because